Women's Month Friday session. I just want to welcome you all, and Vuyo, I'm going to hand over to you. Thank you.
Great. Thank you very much, Anita. Good afternoon, everybody. My name is Vuyo Tegiana. I'm the Manager for Monitoring and Evaluation at the Jobs Fund. I'm thrilled to welcome each and every one of you today to this webinar. Thank you for joining us as we delve into the world of microfinance and explore the results of the Jobs Fund's forage into this space, as well as the emerging impacts that we have realized with our partners from Phakamani. Phakamani means arise. It is an admonition to stand and be counted, to take control of one's destiny, and to live to your best potential. We will see this afternoon that this is a call that the participants of the Phakamani project have indeed embraced and continue to strive toward. Before we begin, let me give you a brief overview of what you can expect from today's presentation. We will start by providing you with a concise history of microfinance institutions and their significance in addressing financial inclusion. From there, we will shift our focus to the Phakamani project and its unique delivery model, inspired by the renowned Grameen Bank approach to lending. As we explore the Phakamani project, you will gain insights into how this microfinance initiative has played a pivotal role in empowering women. By employing a sector-specific approach towards lending, Phakamani ensures that funds are exclusively directed towards women entrepreneurs, enabling them to start and grow their own businesses. This targeted approach has not only provided financial support, but also fostered a sense of autonomy and self-reliance amongst women. The stories of these courageous women will inspire you and showcase the transformative power of microfinance. One of the key challenges faced by microfinance project is the cost of servicing rural areas. During our presentation, we will dive into this critical aspect and highlight the strategies and innovations employed by the Phakamani project to overcome these challenges. By employing technology, partnerships, and community-based support systems, Phakamani has managed to extend its reach and delivery of financial services efficiently to some of the most remote areas in the country. In conclusion, today's presentation promises to be an insightful journey, delving into the fascinating world of microfinance and focusing on the remarkable work done by Phakamani. We hope that by the end of this webinar, you will leave with a deeper understanding of the important role microfinance plays in providing a pathway to financial inclusion and empowering women entrepreneurs. Once again, we extend our warmest welcome to all the participants. In the interest of delivering a seamless presentation, all mics will be muted. Participants are encouraged to post their questions on the chat, and the Phakamani and Jobs Fund teams will do their best to respond to your questions and queries. We will allow for further questions during our Q&A segment, which will be toward the end of the session. In our Q&A segment, participants will then be able to raise their hands and their mics will be unmuted to allow for verbal questions. Now, without further ado, I invite my esteemed colleague, Nazim Hendricks, who will also be the facilitator.
Vuyo, you muted yourself.
Apologies. Oh my goodness. Have I been mute the whole time?
No, just when you said you're inviting Nazim. Yes.
Okay, apologies. Nazim, over to you. Thank you very much, everybody.
Good afternoon, everybody, and a warm welcome again from my side to everybody on this call. We hope that you will find today firstly inspiring and also very informative as to what the work of the Jobs Fund, and in this case specifically with the Pakamani Foundation as our partner. Can we go to the next slide, please? So very briefly, as a background to the Jobs Fund, we were established in 2011 and capitalized at 9 billion with a specific aim of testing innovative approaches to job creation by sharing risk with partner organizations, particularly within the private sector, and thereby encouraging wider market adoption of both the Challenge Fund instrument, as well as encouraging adoption of successful job creation by organizations, by organs of state, and the overall market. Now, I think one must make the point that the Jobs Fund is not a mass employment program, right? However, our role is there to complement other government programs who may be mass employment programs by encouraging innovation and sustainable job creation, by finding that better way of doing things and then enabling the rest of the market to follow suit and build back better. The fund works with intermediaries, of which Pakamani Foundation today is one of them, leveraging their network and expertise and scope to access and provide support to our targeted beneficiaries. Now, very importantly, and this webinar is part of this process, that the Jobs Fund has established a knowledge sharing agenda as one of our foundational pillars. And this is supported by a rigorous monitoring and evaluation and reporting framework, which governs the way we measure impact and also events like this particular webinar. To this end, okay, I've said that, so I'm not going to go there. And I think if we go to the next slide, please, I think you're not here to listen to me today. I think you're here to listen to our partner, and I want to introduce, and it's my pleasure to do so, to introduce the team from the Pakamani Foundation, a Jobs Fund partner that are represented by the Chief Executive Officer, Eric Crawford, Kudzai Rujua, the Finance Manager at Pakamani, and also Mitchell Claire-Blanche, who acts as a project manager within Pakamani. So Pakamani, the slogan on their website speaks to the transformation of entire communities is measured one family at a time. And giving effect to that, thus far, Pakamani has issued 550,000 loans to 185,000 beneficiaries, female beneficiaries, and they currently have just over 36,000 active clients. But I think the most important point to make is that the repayment rate on those loans currently, per their website, is at 98%, which gives us a bit of sense because it has always been regarded as a high risk area and an area for institutions not to play in because of the risk. Well, Pakamani has shown, if done correctly, with the right support packages surrounding the funding, this can be done. So without further ado, I will hand over to Eric and Kudzai, who will be leading us in today's presentation. Thank you. Eric?
Thank you, Nazim. Good afternoon, everyone. It's a privilege to be presenting to you today, and I certainly hope that you benefit from this time spent with us. To start, the best place to hear from is indeed our clients, and we've got a short documentary or video that was produced from a team who came out from the US and went into the field and spent a week with our clients and put this together. So if we could show the video, and then we'll take you through a presentation thereafter.
South Africa is incredibly beautiful. I love the diversity of South Africa. So much money and capacity flows through this country, yet it seems to all stick in the first world part of South Africa. Poverty in South Africa is heartbreaking.
It's life-changing to see how people live on a daily basis, the struggles and the difficulties. There was no understanding of tomorrow. It's only about today, because I only have enough for today.
Our mission is to empower the poor, to provide them with training and support, to allow them to take out their first business loan, and then to stay with them and watch them and help them to succeed. That's what we do.
My name is Chula Semelani. I am self-employed. I'm a single mother. I'm staying in my home. I'm working in my home. And I love my business. I love it. It's in me. I think I'm blessed with it.
I used to keep on praying that one day I'm going to have a boutique, my own boutique at town. It's my dream. It's my talent. And I've never been to school. I make everything, whatever you want, I do it.
We believe that poor people are as gifted, as those people. We may say they are educated, but they haven't had opportunities in life.
Paga Money provides a hand up.
Provide credit, provide training, as well as ongoing support to women in rural communities as a way of trying to empower them to be self-sustainable.
Paga Money is a statement. It's a statement that I care.
It's an organization founded by Mark and Shirley Tucker to improve the lives of women and to eradicate poverty in South Africa where we can. We do that through the issuing of microfinance to poor women, and exclusively women, that are willing to help themselves.
In many instances, our clients is women who are heading households without a father figure in the home, and you have children.
I have to put food on the table. I have to clothe them.
Yeah, ngoba esikhathini lesinye bantwana nababuya esikoleni bathola kunganakudla. Kube buhlungu nje vele kakhulu. Yeah, mangikhumbula emuva vele kungilethela inyembeti kakhulu.
Abona ayikho into lebuhlungu njengokuswela indawo yokulala. Ungaswela lokunye kodwa indawo yokulala ibaluleke kakhulu. Thola ukuthi kudla kukho and awathi uthi ukuthola phi and
there's a situation that we got hold of where women were actually eating toothpaste just so that they could have a meal.
You don't eat, but the kids must eat.
Women are the bedrock of our society here.
Paga Money believes that through a woman, a lot can be changed. So we believe that if you give a woman something, she will share with the whole family.
I haven't been to a single centre client meeting where there aren't kids, young kids. So it's either mothers or grandmothers running a business and looking after their kids.
They're entrepreneurs because they have to be.
These people are not poor because they chose to be poor. Sometimes it's circumstances that they did not choose to find themselves in.
We have those minds, we have those ideas, but we don't know where to go with those ideas.
With the background that we have in Africa, where things seem to favor mostly men, and women don't really get to benefit that much.
They're typically unbanked and cannot get access to funds any other way.
Some loans I didn't qualify.
In South Africa, for you to be able to go and get a loan at a bank, you need to have a paycheck.
I'm self-employed, you see. So when I go out for a bank, I'm looking for a loan. Where is your pay slip? No pay slip.
Maybe loan zawukuba ngibomashonisa yabo and then le mali seyikhula kakhulu and then ugcina ungasathi ukuthi uyibhadala njani.
We at Paga Money, we give them a lifeline. We give them small loans to fund their small business.
Sebenzisa imali ebhizinisini yethu.
The interests are not that much. I am able to manage.
Well, our repayment rate is 98% or above. Often it's 99.
You meet clients, in their working environments, in their homes, in their villages, and get to see how hard they work, the conditions they work under, and the selfless way in which they work to improve the lives for not just for themselves, but for their families, is really uplifting.
Beyond their willingness and their desire to succeed, which everything starts there, is training.
We provide them support, make sure that we help them understand business principles.
Fundzisa ukuthi imali ifuna siyiphathe njani, imali ifuna siyisebenzise njani. So sichubeka ngaleyo ndlela leyo, ngalomgomo loyo.
Centers are a place for skills training. It's a place for us to train, but also for our clients to train themselves.
When we issue a loan to them, we don't ask for collateral. The guarantee that we have is the group guarantee.
Because I will not able to take it Pagamani alone. Yes, the Pagamani need us to be a group.
Who are holding themselves accountable.
And that group must be a people that will trust them.
One person looking at another person and saying, if you get in trouble, I'll help you.
People that you have to speak to them, to encourage them. You can do this, you can do this.
The loan that the client pays back, the money that the client pays back, it helps another client.
That's the thing that I really appreciate more than anything, is that they're doing it themselves.
It's mine. I'm proud of it, and I like it. I love to do this job. I'm proud, definitely.
Right. I hope you enjoyed that. There was a bit of a lag. I think that's networks, but I think you got the picture. And yeah, it's certainly what keeps us coming to work every day. So just a brief background. Microfinance has been around since the 18th century, and it was established really to help people out of poverty, and particularly farmers and small businesses. The success of that, and as Nazim alluded to, the high level of repayment from poor people led to its growth in the 1970s. And the primary goal has always been from non-profit organizations, has always been social in the form of poverty alleviation and access to financial services, in this case particularly capital. Became more formalized, allowing people to take reasonable small business loans safely and in a manner that is consistent with ethical lending practices, as opposed to loan sharks, or as we know them, mashonisa. Typically, microfinance operations occur predominantly in developing nations. So across the world, South and Southeast Asia make up about 73% of the total borrowers around the world. Latin America, 16%, Sub-Saharan Africa, 6%, and then Middle East and North Africa, around 3%. The balance coming from Europe and Central Asia. Over time, these markets have continued to grow. They're estimated in 2022 at around $187 billion. And expected to grow to about $488 billion by 2030. And according to the World Bank, about 500 million people have directly or indirectly benefit from microfinance-related operations. And it's very important to note that there is a secondary beneficiary in all these instances, particularly when servicing women micro-entrepreneurs, in that what comes out of the business gets shared amongst at least the family and further into the community. So initially focused on loans and credit, globally institutions have become banks where they can, and they offer savings account, current accounts, micro insurance and fund transfers, which sort of be the full ambit of microfinance. With that, globally, and this is important to note because we are a bit different as Pagabani and indeed as development microfinance in South Africa, in that organizations have moved to for-profit, which comes with bigger loans and often with individual lending. So they've moved up that pyramid.
Good afternoon, everyone. My name is Kudzai Vijua once again. And just to add on to what my colleague Eric has shared with you, firstly, based on the stats that Eric has just shared, it is unfortunate that overall Sub-Saharan Africa only takes up 6% of the global share in the microfinance sector. And this is despite studies showing that in many developing countries, a correlation exists between microfinance and poverty reduction. Now, while many regions around the world have experienced a decline in extreme poverty, which the World Bank defines as living off approximately 750 rands per month, Sub-Saharan Africa region seems to have regressed over the years with an estimated 62% of people living in extreme poverty. Now, development microfinance institutions were set up to pursue the social and developmental goal of poverty reduction, as mentioned by Eric. And this is done by providing access to financial services to the poor and the unemployed, enabling beneficiaries to set up income-generating micro-businesses, which we do not view as micro-businesses only, but as nano-businesses, because nano-businesses are a hidden dimension of SMMEs. Now, this term is more popular in countries like Australia and in Nigeria, where nano-businesses are seen as way below the micro-enterprise category. Now, furthermore, development microfinance seeks to curb inequality in the income distribution, which we all know is currently at its highest in South Africa at 63% as measured by the Gini coefficient indicator. DMFIs advocate for financial inclusion, as already mentioned, which comprises the promotion, creation, and provision of affordable financial products and financial services, which my colleague also mentioned, savings, credit, insurance, underwriting, and financial investment opportunities to all individuals. True to the spirit of this webinar, gender inequality is also an issue that microfinance institutions seek to correct. Women play a significant role in economic development, and DMFIs recognize that. DMFIs, meaning developmental microfinance institutions. 53% of borrowers globally in 2022 were women. In South Africa, over 90% of the sector's clients are women, while that's 100% for Pagamani Foundation, which we believe if you empower the woman, you've empowered the entire household, as was pointed out in the video. Now, in summary, and as a point of departure for me, DMFIs aim to address the problems related to poverty, inequality in income distribution, financial inclusion, and gender inequality right at the bottom of the pyramid.
Thanks, Kurt. I see there's a question in the chat. Do you want that answered now, or should we continue with the presentation, Nazim?
I think, Eric, if you can just answer that and then move on, please.
Okay, super, thanks.
All right, I'll answer that question. I'll take that on. In as far as the success of an MFI is concerned, it would be better understood if we first spoke about mission drift. While access to credit is pivotal in poverty alleviation, many microfinance institutions globally have over the years suffered criticism for failure to remain focused on their social objectives, which is to concentrate on adjusting their returns on social portfolio. And instead, they shift to commercialization, which is the application of market-based principles to meet shareholder or financial objectives. Now, for an MFI to be successful, a balance needs to be struck between what we term outreach and operational self-sustainability. Now, this is called the trade-off theory in microfinance. And outreach, basically, there are two most well-known indicators for microfinance institutions that are classified under outreach, and that is breadth and depth of outreach. Depth of outreach refers to the types and levels of poverty of clients supported by MFIs. And when we say types and levels of poverty, we're referring to the societal factors that are considered when you look at the depth and the impact that the poor are faced with. For example, is it female clients? Where do these people reside? Is it in rural areas? So that's what we call the depth of outreach. The breadth of outreach refers to the number of active clients served by microfinance institutions. So outreach, in a nutshell, considers the number of clients served by microfinance institutions and how poor they are and their social class. Are they women? Are they residing in an area that has got basic services and facilities? So that's the first element. The second element that we consider for a successful microfinance enterprise is the financial sustainability, which is measured by operational self-sustainability. And this refers to the company's capacity to earn enough revenue to cover all of its costs. Operational self-sustainability is essential for assessing an MFI's capacity to operate sustainably over the long term while carrying out its social mission.
Great, thanks, Kurt. So if we can continue on the slide, the next slide, which is up. In the late 1970s, Professor Muhammad Yunus in Bangladesh, in response to extreme levels of poverty, financial exclusion, and inequality, which Kurt has just alluded to, developed what is known as the Grameen group lending methodology. Now, Grameen means village, and he started servicing microbusiness, women in microbusiness in a Bangladeshi village in that time. He hoped to provide business loans at reasonable risk, again alluding to what Kutzi's just said, and low rates so that they were affordable for people. I had the privilege of meeting Professor Yunus a few years back, and he strongly believes that poverty belongs in museums, and that people that empower themselves in business rather than looking for permanent jobs is a great way of alleviating and reducing levels of poverty. In 2006, he was awarded the Nobel Peace Prize for his work on economic and social development. So we've mentioned the key components, capital savings and credit. What we didn't mention or hadn't mentioned yet is financial education. And this is an important part of what we do. So financial inclusion needs to go beyond pure access to finance and into how do you use your money best. And we'll talk more to that just now. At short-term loans, typically 4 to 6 months in a year. Collateral is social collateral, so it's held across the members of the group and indeed within a center, as Nazim mentioned. And then there's biannual, bi-monthly or monthly center meetings. These are chaired by clients. It's not a Pagamani meeting. We train up center leadership to manage and host those meetings and then just facilitate the admin in those meetings. Included in those meetings, it's a place where we don't handle cash. So in those meetings, we will collect slips. We will disperse in the form of letting the group know that the funds will be available in their bank for withdrawal. And then it's also a second level of solidarity, client solidarity and support. And generally the group lending, as Kudzi also mentioned, is predominantly aimed at women. In Pagamani, it's exclusively aimed at women. Next slide, please. Okay, so microfinance, microcredit started in South Africa in 1987. And just to clarify, globally, microfinance is what we talk to in terms of business loans to disadvantaged or marginalized people. But in South Africa, there is a second, there are microfinance institutions, several thousand, that differ from us, and that they are primarily focused on consumption lending, and the businesses have a profit motive, whereas the development microfinance focuses on an income generating activity, i.e. a small business, financial inclusion, and poverty alleviation. Since 1990, over 45 DMFIs have started operations and closed down in that period. And currently there are only 3 development microfinance institutions operating. Some of the key reasons for that is the high cost to serve, and we will delve into more of that in detail. Maybe some financial discipline or indiscipline and poor governance. Research was done on this a couple of years back, and those were the key findings. So in those three organizations, the one that we opened 32 years ago, Small Enterprise Foundation, they have about just under 150,000 clients. Then Pagamani Foundation sitting at around 36,000 clients, and we're 15 years old this year. And then Sunrise Women's Development started about 2 years back in KZN, and they've got about 2,000 clients. All of those organizations have applied some derivative of the group lending methodology as established by Grameen Bank. So I see a question from Letabo. Letabo, I will answer that in a minute if you don't mind. I will get your question in the next slide. So we operate across as an associate, as a group of MFIs, DMFIs. We operate across 7 provinces, servicing about 221,000 clients, 1.3 billion dispersed annually. That was as high as 2 billion prior to COVID. A gross loan book of 500 million, also was touching on 750 million prior to COVID. Cumulatively, our clients have savings around 76 million. We don't mandate savings, but we do encourage it as part of the financial discipline. From inception, 17.3 billion has been dispersed, and the sector employs about just under 1,300 people. The products are all for credit for business purposes, with primary objectives being financial inclusion and poverty reduction. I'm going to speed up a bit because I see we are going to run short of time otherwise. Could I have the next slide, please? So just to give you a bit of a picture of what we've been through over the last couple of years, the graph represents the gross loan portfolio, and then I've just shown Pagamani on there as well. So you'll see the sector was growing well up until 2020, just given that these are as at June of each year, because all of the organizations in the sector have a June financial year end. And you can see, so 2021 wasn't impacted too badly, but then 22, 23, we've seen a continued reduction. And really where the issues came in during COVID, reduced areas to operate, so schools closed, women who were running tuck shops or making school uniforms, obviously that impacted them. Also those servicing tertiary institutions, prohibition of large gatherings, so big gatherings in the year like the ZCC gathering in Limpopo and Shembi gatherings in KZN is a prime area for clients to sell. Some clients work a big chunk of the year just to prepare product for those meetings, and those weren't allowed. And then obviously house-to-house sales were impacted. Issues around restocking because of the restrictions on travel. A lot of our clients in the rural areas will go to the main centers to buy bulk stock and then take it back to their businesses in the rural areas. They too, as in our clients, customers were under pressure, and so our clients that operate on credit or level of credit saw an increase in defaults, uncertain and volatile conditions. We just experienced a general loss of confidence in starting a new business. And then obviously lower volume. Post-COVID, if I can say post-COVID, we saw the market improving and then dropping again. And that's in 2023, primary things that we believe have impacted our clients, load shedding, and people in rural areas are impacted significantly by load shedding. Those that are cooking or selling meals, sewing, selling meat products where they need a freezer or fridge for cold drinks, all of those businesses were significantly impacted. And just, I think many people think of a spaza shop when they think of the clients we serve. A spaza shop might carry 50 to 100 different lines of product, whereas our clients may only have 3 to 10 lines of product. So if a couple of those are impacted, it impacts the whole business. And then just generally lower levels of disposable income in the rural areas, obviously impacting our clients' customers. You can go to the next slide. So just continuing, I've included Phakamani's history in terms of the loan book in the presentation for 2 reasons. One, to show the size of Phakamani in the market. So while we're the second biggest player, we're still smaller, significantly smaller than SEF. But also the fact that we haven't had the same level of drop-off in the years 22 and 23. Big reason for that is that we continued during that time and through COVID to open branches. And that's on the back of the partnership we have with the Jobs Fund. So it really has enabled us through the partnership to continue in some very tough times. But then if we go on to where we are today, the increased cost of living, so cost of fuels, transport and materials. As I mentioned, clients will often have to pay transport to get through to the economic centres and buy product to bring it back. They are unable to increase their prices at the same rate as their input costs, which obviously affects their profitability and margins. Customers, our clients' customers or beneficiaries' customers are also starting to buy in bulk as a way of saving, because obviously the flexibility of buying from somebody in the community comes at a bit of a premium. And then there was a significant increase. Many clients bank with Postbank. It's got the biggest footprint because it came off the back of the post office. But in 2020, the Postbank moved from a flat fee of 16 Rand per withdrawal to a escalating fee along the lines of the commercial banks. And that made it significantly more expensive for our clients to bank. Clients have challenges in opening and operating bank accounts, load shedding being one of those. Because these aren't the most profitable bank accounts, some banks, don't encourage it. Every group account, because they open a group savings account, means opening doing FICA for each of the individuals in the account, which is time consuming. We've also noted an increased level of crime with the economic conditions in rural areas, and then increased level of service delivery action, and we expect that to probably get worse leading up to the elections next year. And then a proliferation of strip malls going quite far into some of the more rural areas. Next slide, please. So now just into Phakamani itself. We started dispersing in 2008. We currently operate, well, we started in Mpumalanga, then Limpopo, with a jobs fund into KwaZulu-Natal, and currently we've expanded into the Eastern Cape in our current project with the jobs fund. We currently have 55 branches nationally and about 385 employees. If you just look at the graph, which I hope is clear, the number of loans dispersed per year, which is one of our measures, you'll note quite a steep increase from 2015, 16, 17. And that's on the back of the KwaZulu-Natal expansion, in addition to a couple of branches opened in Limpopo. Distinct impact of COVID, 2019 to 2020, given that we were impacted for 3 months in 2020, with one of those months being a hard lockdown, during which we closed operations and sent our staff home, and then continuing into 21, largely COVID, and then starting to grow again. That 21, 22 is phase one of a current jobs fund project, and then that dip into 23, which is where we are currently, and that we believe is largely due to some of the factors I mentioned in the previous slide, primarily economic, and we're looking to ways to address that, and have seen a bit of a positive trend in the last 2 months, which is awesome news for us, because it means clients' businesses are starting to improve profitability. As he mentioned, 36,000 clients, 185,000 individual women served since we opened 15 years ago. We've dispersed 1.3 billion from inception, but that has grown exponentially in that we currently disperse just under $250 million a year into the most remote rural areas of South Africa. And then again, Nazim spoke to the total number of individuals through the group loans. Next slide, please. Question. We mentioned that we would talk to, Boya mentioned the high cost of lending and how this works. And it really is a high cost model in that it's, we have, in each of our branches, which has a branch office, which only happens, meetings happen once a week, and they're largely administrative and some training. But otherwise, our staff are on foot out in the communities that we serve. So recruitment happens door to door, motivations of gatherings of women at churches or social events. We do distribute pamphlets, particularly in new branches. Our word of mouth, existing clients are a great source of finding new clients. And then before we open a branch, we introduce ourselves to the local authorities, including the traditional authorities, and those people will often know their communities well and point us in the right direction or point clients to us. We then have a meeting with clients, give them a basic overview, and introduce clients to the center. The centre meeting has veto on groups joining Pagamani because of the social collateral within both the group and the centre. So clients are introduced at the centre, and centre leadership will take a decision on whether they will admit a new group into that centre. Following that is a stage called group formation. And I'll going through this to show the amount of contact we have with the clients. All members must attend that. The branch manager will visit each of their homes, confirm that they understand what is happening, make sure they've made family members aware, so their partner or parents or whoever they live with, that they are looking to take a loan and start a business, and then just an understanding of what that means in terms of repayments. And then they're approved for training. So this is the start of some of the financial literacy training, where they trained over 3 or 4 days, not full days. We respect the fact that time out of the business is expensive for our clients. And we teach them a couple of system principles. You can do it, it's a loan, it's a hand up, not a hand out. We believe it's more sustainable than charity, particularly to a business person. There's strength in the group, and they should follow the system, which includes attending centre meetings, etc. And then some basic business principles, buy the right stock, sell at the right price, right product, right profit. We don't advise on what business clients should go into. We again respect that they know their communities better than we do, and will know where there's demand. And then they open a group savings account, which is the account we disperse into. And then the branch the manager will come back after the training, make sure that everyone attends, that the training has happened, clients understand key principles. And this is very important in ensuring that we don't over-indebt anyone, confirm the loan sizes, and confirm installment amounts to be paid. Really important here, and that's why I keep saying all members must attend, is this model. And the reason we can achieve 98% repayment rates is because of the solidarity within the group and the cohesive strength of the group. And so that's why that is encouraged. You can go to the next slide, please. So this talks a little bit to the cost to serve. So just briefly, those headings: agriculture is primarily chickens. We don't have the model for microfinance for crop farming, and stock farming is quite different in that there's a high upfront cost, and then you sort of wait quite some time for harvest to get repayment. So we don't do that, but we do have some people in agri. Multiple is where clients are running more than one business, so they might be selling food during the day and doing sewing at night, or selling products like Tupperware and Haverish Lane, in addition to airtime. So they have multiple businesses. Production, mainly sewing and knitting, services, catering, cosmetics, hair salons, tailoring, and then retail. The most significant portion is buying and selling new or used clothing, shoes, fruit and vegetables, tuck shops, spas, and restaurants. So I showed this because we have intentionally focused and intend to maintain focusing on what is known as the bottom of the pyramid, not the nicest term. So to recruit, train, and disperse a new client costs around 500 Rand. So just to break even on that process, we need to disperse clients of over 2,800. And you can see 63% of our clients are below that level. Rural areas are obviously significantly more expensive to serve in terms of travel time, travel expenses, because of the lower densities. Longer term loans over 1 to 3 years are cheaper to administer. And just remember that we do meet with our clients every month. in centre meetings, and each loan officer would conduct several of those. We do business verification and social data gathering at each loan cycle so that we can monitor impact. Cost of labour in South Africa is relatively high than other developing economies. Our staff may not necessarily agree, but that is proven. And then higher loans at volume improve self-sufficiency ratios. So we really are at this stage looking to focus on helping our clients grow up, grow their businesses and grow up the loan size graph. Next one, please. Next slide. So the graph on the left, and this is really shows very clearly the impact of some of the decisions. So one back, please. Can we just go to the previous slide, please?
Zamili, are you there? Oh, there we go. Thank you.
Okay, super. Thank you. So you can see on that graph, if you look at before 2015, there was a conscious decision and strategy to expand, both from a social mandate, but also from a sustainability mandate. And it was at that time that we entered into the first partnering agreement with the Jobs Fund and opened into KwaZulu-Natal. So the reason for the growth was to achieve economies of scale in servicing clients, and therefore hit a critical mass where we could start becoming more sustainable. So you'll see, if you go from 2015 to 2016, that was the first year of the Jobs Fund project, and the dip in sustainability comes about due to the investment in opening new branches. But then there was a significant gain over the remainder of that project, which was 3 years. For the whole organization. And that really was one of the sweetest projects we've ever experienced, because KwaZulu-Natal, the previous development microfinance organization had shut down, staff had lost their jobs, and there was therefore a fertile ground of people who knew what they wanted and knew how to operate in microfinance. And we had the backing of Jobs Fund, so that was incredibly successful. 2017-18, post that project, we continued opening in Limpopo, and you can see the impact of that investment there. And then the OSS started growing again until COVID hit. Now, projections prior to COVID is that we would have reached sustainability by this last financial year, being June 2023. But you can see we are nowhere close to that currently. And the recovery that started post-COVID in 2021-22, we've now flattened out a bit in 23. So that's the reality of the cost to serve. Primarily is salaries and travel costs, and those are relatively fixed in our environment. If you look at the right side graph, that just gives you an indication of where the revenue comes from. And currently about 60% of our operating costs are absorbed, are covered through the revenue we earn, and the balance comes through donations, the Pagamani Trust, and at this stage, the Jobs Fund. About 31% of the operating costs come from that. Next slide, please. Okay, so this is why we come to work, and these are stats we collect at every loan cycle to understand what change there's been. So the first graph shows that loan amounts are growing. Now, to take a bigger loan, you need to have saved, you need to have paid your loan off well, You need to have attended centre meetings, not all of them, but most of them. So the factors that determine a growing loan is really a healthy business. And that's why we track that. And you can see the x-axis is successive loan cycles. So you can see on average, as clients enter into second, third, and fourth loans, those loan amounts grow. And why do they grow? One of the key factors that I haven't mentioned yet is that the business value is growing. So on a very simple balance sheet, we value the business at each successive loan cycle and then collect those stats. And again, there you can see on average, as successive loans are taken, the business value typically grows. And clients are able to save. So another indicator of impact is savings. And then the final graph measures progress out of poverty, which is an international measurement, and it's customized for the countries that use it. And South Africa has its own customized PPI tool. And what that shows at a level, the first, second loan, 42 points indicates that there's a 30% chance that that client will be below the national poverty line. Whereas if you go into successive loan cycles, at 52 points, it represents at about 5% probability that a client will be below the national poverty line. So quite a material change in their well-being over successive loans. Next slide, please. So as I mentioned earlier, the best measure or the best way of understanding Phakamani is through our clients. And we just got a few samples here just to share the kind of impact that a loan can make. So Nesta, who's local here in Mpumalanga, took a first loan of 1,000 Rand in 2011. She purchases scrap metals, melts it down, and uses a mold to make cauldron pots. She custom makes them by size, and she'll even put your name on it. In between that, and for additional income, she hires out pots for special occasions. And I think just how creative our clients can be and how hard they work across multiple ideas to bring home money for their household. She's built a workshop and a house. She put her child through school, and she employs 2 women in her operation. So that's part of the knock-on impacts that I was talking about earlier. Jane saw high demand for quality food in her community. She took a loan to purchase meat and pay for it to be transported, so bulk. Business has done well. She's added onto a 2-bedroom house. She now accommodates her whole family of 7. And she's put 3 of her children through tertiary education. Very typical of women households, and the reason we service women is that the money that comes in will typically be passed on to the family. Maria took a loan in 2014. She has 26 loans since there. She's grown her seamstress business. She built a garage to work from, 2 new sewing machines, and has been able to support her family better. Sibongile took a loan of 1,200 in 2018. She used to sell cosmetics. She's diversified into multiple retail products. She said she battled through COVID, but she's doing well again. Her daughter has studied further, and based on several successful loans being paid off, she's currently on a loan of 25,000. So first loans, you can move on to the next slide. First loans start at 1,000 Rand and go up to 3,500. And our maximum loan size at this stage is 30,000, which we review each year. Just some indication of how we've worked with the Jobs Fund in KwaZulu-Natal, which was March 2015 to Feb 2018. Over those 3 years, we trained 17,500 beneficiaries, created 4,133 beneficiary jobs, and dispersed capital of about 60 million. But because of the nature of the work we do, that continues. So in the past 5 years, we've trained an additional 42,000 beneficiaries, created nearly 11,500 jobs, and dispersed capital of 380 million. So year on year is what is represented in the model there. So capital dispersed, for instance, was around 20 million a year. It's now 76. Jobs created were just under 1,400. It's now 2,300 a year. And trained beneficiaries was 5,800 a year. It's now 8,400. Very quickly, the current project, which is much newer, Eastern Cape, on the next slide. Again, we're seeing the positive outcomes of the project continue. So you'll see the margins are smaller, but we're only 1 year post the project. So whereas we trained 3,800 beneficiaries per year during the project, we've trained an additional 4,100 in the year thereafter. 772 jobs created per year is now 1,165, and capital is dispersed per year has moved from 17 to 28. Next slide, please. I'm conscious of time, and I know there's some questions, so I'm going to go through some of the key learnings. Okay. So really what we've seen is that development microfinance, using the group methodology, is highly effective in reaching rural people, in our instance, women who are unbanked and unemployed. High rates of success in assisting clients to start or grow their micro business and provide an income for their household. Really importantly, and we've heard this from our clients, is that it creates hope for the current clients, and it leverages success for future generations. It's expensive to operate in rural areas, requiring a subsidy of at least 10 years. As you can see, we are still requiring subsidy after 15 years. And we believe what we've seen is that subsidy has come through government grants, individuals, Pagamani, US and Canada provide large donations to us, preferential loan rates through government. These are things that would help going forward. Bank charges are quite material to our clients, very material. And we see those rates going up. So we'd love to see a savings product for group savings, specifically to this sector, and then obviously reduce bank charges to ourselves. Bank charges being our third biggest expense. Then opportunities to reduce operating costs. We're busy looking to digitize our loan processes, to save on courier fees and printing costs. Mobile banking, there are initiatives already, one under the Reserve Bank that's in pilot, that hopefully will get our clients using mobile banking, in which case we could save money in terms of our transactions between ourselves and them. And then really for success, you need a strong donor base and grants right from the beginning, and sort of patient capital until the organization can stand on its own feet. Thanks, everyone. I'm done with the presentation. I realize I didn't give my colleague much chance to speak, but I was conscious of time. I was preparing for the questions.
Thank you, Eric. I think people can start raising their hands for questions. We will be unmuting the mic shortly, but just some questions that has been posted in the chat, Eric, that you may have answered, but I think it's worth just answering them quickly again. Mzamu asked, is the interest rate the same as commercial banks? And then Sindisiwe asked, how does Pakamani address the tension between its social mandate and sustainability? I think you've actually answered that question on one of your slides. Sandeep wants to know, what does proliferation of strip malls mean? You had that in one of your slides. Is something that's impacting your operations? If you can answer those three for me quickly. I have two more, but if you can just answer those three for me first, please.
Okay, so we are governed by the National Credit Act and the National Credit Regulator, and there are specific rates allowed for development lending, and we stay within those rates. They are, yeah, we actually stay coming below those rates. In terms of the banks, they don't lend to this market, so we can't really compare to that. But if you compare to informal lenders and unregulated lenders, it's significantly lower than the rates in the market. To give you an indication in terms of interest rates on a R1,000 loan is about 6.5% over 4 months.
Thank you, Eric.
In terms of the tension between sustainability and social mandate, I think Kudzi addressed that in quite a bit of detail.
Yeah.
But happy to be contacted outside of this forum if anyone wants more detail. And the last question was around
the strip malls, Eric.
So in our clients obviously are convenience to the customers they serve. Where bigger sort of malls come in and offer more variety and possibly cheaper rates than our clients because they're buying and selling in bulk, that affects our clients' businesses, which in turn affects us. And we have seen a number of these malls going up in the rural areas in which we operate. So that's what I meant by that.
Okay. Then the question, there was an unknown user, there was no name attached. Do you have insights on stokvels and other non-formal or non-formal lending that occurs in the informal economy? What incentives could be used to encourage micro enterprises to move towards being banked? And have you captured the unbanked market?
Okay, so we are aware of other financial systems that exist in the communities that we serve. So we are aware of the stokvels, we are aware of reciprocal interest-free loans that the people give each other, and we are also aware of the mashonisas who are operating where we serve our clients. Now, microfinance is based on the idea that all of these financial systems, they're hampered by problems. And as such, they lack resources and inability to meet members of the stokvels needs, such as the inability to pay for funeral expenses or the grocery needs of larger families, a lack of economies of scale because money accumulates more slowly and there's more room for expansion. Stokvels, they unquestionably provide beneficial indigenous savings methods that communities adopt. However, anything beyond that may be too administrative and difficult to manage. So as microfinance institutions, we are more structured in how we do things, and we are focused primarily on financial inclusion. With mashonisas, I'm sure you are aware what type of tactics they engage in just to recover their repayments. This is besides the high interest rates they charge. So, yeah.
Okay, thanks. And then one from Andisa, Eric and Kudzi. What initial funding is required for a development microfinance institution to achieve sustainability? And if I may, I'd like to ask to that, additional to that, if you can add to that, how better can government assist this industry to expand its impact?
I'll take the first half of that and maybe Kudzi will answer the second half. So sustainability is, the measure we use is purely revenue earned over the cost to earn that revenue. Grants and donations obviously help the organization run and stay afloat, but for that reason, don't impact sustainability. So when we measure sustainability, we exclude grants. Obviously, on our income statement, grants and donations come in, and that's the cash flow we need to keep the operation going. In terms of funding our clients, we have multiple loans, which we're able to service and on-lend to our clients. So it's the operational side, significant amount of funding, particularly in the first 5 to 10 years.
Okay. And the issue around how best government a better way for government to assist this industry?
We believe first and foremost a sound legal and policy framework in support of development of microfinance activities. For example, the capitalization of microfinance institutions, as Eric has mentioned, is critical and needs to be given considerable attention. We're looking at even issues at the macroeconomics, taxation of the MFI supplies. You know, the VAT that we charge on our services, that's an additional 15% cost on our clients, and that concerns us. And we're looking at banking legislation. Over the years, statutory and banking legislation has prevented the use of financial technology to deliver financial products and services, like we see in Kenya, where the M-Pesa. In South Africa, that we haven't gotten to that point as yet, and yet that can significantly lower the costs for microfinance. And at a high level, communities without essential infrastructures like decent roads, reliable power supplies, and good transit systems, they are almost not able to benefit from microfinance products. So the government can address that at a higher level. Yeah.
Okay. And then there was a question from Nokuzola's question was answered. And please, if everybody can notice that the website and the email for Phakamani has been posted. So if you need to talk to Phakamani directly, please do so. There was a question, do I have to be registered on CIPC to access a loan?
Absolutely not.
Okay.
Because of the size, it is informal, and just maybe tacking onto that, needs to remain informal. These are very small businesses, and I think any attempt to formalize it, registering with SARS and SIPC and that, will just kill the sector completely. This is much too small for that. And I don't believe there would be any benefit to either government or these institutions in doing that.
Yeah.
And then I saw a question from Bianca as well, which I'll quickly answer. Because of the social mandates, we don't take action on clients. Because it's group lending, we don't report clients or blacklist clients. We can't report them to a credit bureau because of the nature of the group. They what's the word I'm looking for? Not co-fund. They stand in for each other. So yeah, if somebody fails, we believe the group has failed. The only penalty is we will not give another loan to a group that has a write-off.
Yeah. Okay. I think if there's another question here from Tato, who says, I've just started a business where I want to lend to small agricultural enterprises. But after I did a feasibility study, sure that the company will be able to, it's not sure that the company will be able to pay back the loan. What should I do to qualify collaboration with the Jobs Fund? I think that's more a question for the Jobs Fund. I will ask one of the Jobs Fund client, Kath, if you can please answer that question for Tato. Is there any questions? I don't see any hands up at the moment of people with questions. Yes?
So, Nazim, there's a question that was asked earlier. Maybe if I can briefly try and answer it with regards to how a microfinance institution can ensure fulfillment of its financial and social mission. Just to be clear, yes. First and foremost, we stay focused on our social mission by keeping the loan size inclusive and low, despite it being not profitable. Because we have a social mission, we don't aim to seek profiteering first. We continue focusing on development rather than consumption loans. And also we continue supporting women in rural communities, even if it makes more sense to support those in townships or in urban areas, we remain fixed on these clients. And that's basically what we call outreach, fulfilling our outreach mandate.
Thank you, Kutsi. Really appreciate that. And there's been a lot of requests for sharing of presentations. That will be done. It's also available on the GTAC website. Please, can I request humbly that people take a minute to complete the form, the rating form, so that we can also improve in the way that we do this going forward. I don't see any hands from people. So thank you, Eric. Thank you, Kutsi, Mitchell. Anita, you've got a hand up?
Yes, no, sorry, Nazim, you've covered me. Thank you.
Sure, thank you. So with no further questions, let me just see, there may have been one more in the chat. Okay. We'll do, oh my word, now it's coming fast, right? Leanne, Gabriel, do you think the microfinance model can be applied to urban settings, example, townships?
It can, and it has. I haven't seen a successful implementation in South Africa. I think one of the keys of our success in rural settings and working with women is that's the family house. There's stability. Some of the criteria is that clients have lived there for 2 years, that they've known each other for 2 years. There's a lot more of a mobility in more urban areas, and that can raise issues when somebody in a group is unable to service the loan and can lead to the whole group collapsing. So yeah, it could be done. It has been done elsewhere in the world, but we don't do that.
Okay. Then Leanne, I'm sure the Pakamani team would be happy to engage you. The website, it has been posted. Yvette asked, is there one particular client story that has stood out for you? Because I think that's why we do this, right?
Yeah. So there are lots, and it is what keeps us coming to work. But when I joined late 2015, I remember visiting a client who was, it wasn't the client in the video, but a client who was cutting hair on the side of the road under a bit of a tin shack. And I visited again, coincidentally, about 3 years later, and she had built a salon. She had running water with basins for washing hair. And I applauded her and said, this is a fantastic thing that you've achieved. And she said, that's not all. She had built herself a house, and she had built 3 rooms that she was letting out within 3 years. And I just think for a woman to have that drive and that initiative and ability, which we see in most of our clients, I haven't forgotten that, and it's about 6 years old as a story.
I think Palesa had a hand up. Palesa, you've dropped your hand. Does that mean you've been answered, or you still want to ask your question?
Yes, I still want to ask a question. I just want to find out if ever we are based in Gauteng, can you also apply?
We don't have operations in Gauteng. We have operations in Kwantlanga and Siabuswa, which are the closest, and some of the clients might reside across the border, but we're not active in Gauteng currently, no.
But it is watch the space, right, Eric?
Yeah, look, we're licking wounds a little bit at the moment. We're consolidating for growth. We certainly will be growing again in the future, but yeah, there's still opportunity in Eastern Cape, there's still opportunity in Northwest, and that would also then obviously be Gauteng in the middle of that.
Okay. Thanks, Eric. Thank you, Kutsi. Thanks, Mitchell, for addressing the questions in the chat. I don't see any further questions or any hands. I think I'm going to hand back to Vuyo for closing comments. Thanks, Vuyo.
Thank you. Thank you very much, Nazim. Ladies and gentlemen, we've come to the end of our webinar session this afternoon. We hope that you found this session useful as we've explored the Phakamani Microfinance Project and its impact in the lives of women in South Africa. It is fitting that we close out this Women's Month with an inspiring initiative such as the Phakamani Project, which is successfully uplifting some of the most vulnerable women in our society. We hope that this webinar has shed light on the transformative power of microfinance, not only in its potential to support the revitalization of rural economies, but also in empowering rural women in allowing them to take up their rightful place in their households and society. The Phakamani Project has exemplified how targeted lending can empower women and create sustainable livelihoods in rural areas. Through a combination of technology, collaboration, and deep community involvement, Phakamani has successfully brought financial services to those who need it most. By providing access to capital, training, and mentorship, Phakamani has empowered women, enabling them to grow their loan sizes and businesses, break the chains of poverty in their families, become agents of change within their communities, and by so doing, creating a more equitable society. So on behalf of GTAC and the Jobs Fund, I want to extend a special word of thanks to yourself, Eric and Kudzai, for sharing the Phakamani story with us today. To the participants, thank you for your engagement and enthusiasm for this topic. Ladies and gentlemen, let us carry the lessons learned today into the various areas of work that we're involved in our daily lives, and continue championing initiatives that empower women and promote inclusive economic growth. And with that, we want to say thank you very much. Have a good afternoon further, and we wish you a good weekend as well. Cheers, everybody.
Bye, bye, everybody. Thank you.
Thank you. Bye.
Bye. Thank you.